So looking at the solution, guys, the question 1 was per engagement, reference ISA 220, some paragraphs you can go and have a look at. So the concerns were with regards to the competence, capabilities, and resources of the engagement team. When you look at the 2 first-year clerks, they don't meet any of the requirements for competent and capable in terms of sufficient knowledge, understanding of professional standards, technical expertise, ability to apply professional judgment, or understanding of the firm's policies or procedures. In addition to that, you look at the manager and the partner. They're the first time on this client, so they don't have experience. There's also new listing requirements because they listed at the beginning of the year or the end of the prior year. So all those listing requirements are going to be new for the first year clerks. And there was no engagement quality control reviewer, which is required because the limited company, the holding company, is listed. Okay, then is 2 enough, considering prior year had 4 engagement team members, 2 would have been the partner and manager, but now there is a consolidated financials as well. Why you would accept? Because you have been the auditors for the holding company for so long. Ultimately, a conclusion not to accept with the current team and time restrictions. Okay, the impact on the information in the scenario, on the planning of the audit. So all the risks that affect the company, here they are. They listed the rapid growth, the franchise agreement, the revenue targets in that franchise agreement, the foreign subsidiary, and then the fact that they do import from that foreign subsidiary. So the foreign regulations, and then the effect on the purchases or the inventory. They are owner managed, the issues around that accounting system, it's not integrated, the financial director doesn't have the knowledge, and then the tight deadline. Then with regards to the group, all your standard risks, consolidation is complex, there's the additional translation because there's a foreign subsidiary, but other than that, intercompany, inconsistent accounting policies, the 2 related party transaction and related party itself risks, and then the component auditor. The responses, no detailed audit procedures, so I pull them straight from your A1 in ISA 330. Look at your team, get more experience, get more supervision, increase unpredictability, corroborate management representations, or get more third-party representations. Okay, lower materiality, and then the general changes to the audit plan. And then finally, the impact on the control deficiencies with regards to the group. So the group auditors have to be aware now that there's a control deficiency. They have to consider, is it significant? Does it result in a significant risk? Is there management override or fraud? So what is the impact on the separate financial statements of the components or subsidiary? They must go the substantive approach because the controls are not working, so don't test them. Detail then the nature of the substantive procedures, the timing mostly at year end, extent, increase and lower. Now it's component materiality. Some overall, evaluate evidence, be more unpredictable, increase professional skepticism. Then at a group level, looks like controls do exist. There's an expectation that they do work, so you want to perform tests of controls. So you go the combined approach. Your nature is all the control testing, analyticals, and test of detail. Use CATs, looking at the timing, controls must be tested throughout the period, and extent, increased test of controls, and analytical, decreased test of detailed procedures. Okay, the last question, asking the principles or testing the principles in a different way from what you used to being asked. Okay, but I just want to get you guys thinking so that you can handle if you get asked it in a different manner. Super, guys.